All right, and we're back. Hey everybody, welcome back to the channel. Since my last video here about a week ago, we've over doubled in subscribers. So I want to say thank you to everyone that subscribed to the channel. I'm really excited to have you. If you're new or this is the first time you've watched one of my videos here on YouTube, I talk about building passive income through dividend growth investing, sharing my journey here on YouTube. And typically what I do is I talk, in every video I like to share an update on my portfolio, as well as talk about a topic in each individual video that is either relevant at the time, this maybe something that is in the news, or something that I get asked a lot on either here on YouTube or other forums like Reddit and so forth. And in today's video, I really want to talk about the concept of dollar cost averaging. And after I talk about dollar cost averaging here in the first part of the video, I'm going to then go in and talk about the portfolio, share how everything has been going for the last week. And as you know, this last week has been pretty bumpy for most investors. All right, so and we'll dive into that here in a second. So first things first, I want to dive into dollar cost averaging. And I want to start, you could simply just go and Google, okay, what is dollar cost averaging? All right, and you'll get a pretty textbook answer of, okay, well, dollar cost averaging is this. And what I want to do in this video is really take a look at it from a perspective of a new investor, somebody that is not in a position where they have thousands and thousands or even millions of dollars sitting in their bank account. Somebody that has a 9-to-5 job, somebody that works for a living, or somebody that's maybe just new and just starting out, that doesn't have a large sum of money just sitting around. And that's important, and I'll touch on that here in just a second. But before I do that, I want to, when we talk about these concepts, dollar cost averaging, what is it? Is it a good idea? Is it a bad idea? You might go on YouTube and you type, okay, should I dollar cost average when investing? And a lot of times we look for advice from those well-known individuals that are successful. Those people that are wiser than us, that have had more success. We often look to Warren Buffett for advice and for guidance. We look at him as a teacher. When Warren Buffett was asked, well, what do you want to be most well known for? Your money, for your influence? And he said he wants to be best known for being a teacher. And Warren Buffett also had a teacher. An individual that he looked up to was, for example, Benjamin Graham. Benjamin Graham was a British-born American investor and professor. He was known as the father of value investing. So Warren Buffett, when he first started out, when he was starting to invest, he looked towards Benjamin Graham as a teacher in investing. And Warren Buffett is most well known for his value-oriented investing style, that buy and hold. And this is kind of how I want to start off by talking about, well, what is dollar cost averaging? Okay, and if we go over here to Investopedia and we look at an article here on Benjamin Graham's timeless investment principles, we scroll down here and what is dollar cost averaging? And Graham suggested to help mitigate the negative effects of market volatility. And one thing is certain, though we can't predict where the market is going to go in the future, we can know with 100% assurity that the markets are volatile. They go up and down. It's healthy. It's just how things work. And now one can argue, and I'll touch on this in a second, that the markets go up more often than they go down. And that has an implication when it comes to dollar cost averaging. But, for simplicity's sake, dollar cost averaging is achieved by buying equal dollar amounts of investments at regular intervals. Now, if you have a brokerage account like Vanguard or TD Ameritrade or E-Trade, you have the option to make automatic transfers maybe once a week, every 2 weeks, or once a month. And also with Robinhood. Now, other brokerages, for example, with M1 Finance, you also have the opportunity to make daily transfers. So really this concept of dollar cost averaging is here to stay. And no one can predict the future. It doesn't matter, how great you are, what your track record is, no one can predict it. And so the concept of dollar cost averaging, it takes advantage of dips in the price and means that an investor doesn't have to be concerned when buying a position, if it goes up one day or if it goes down one day, because essentially you're getting the average. And as we know, 99% of people cannot beat the market. Even your best fund managers struggle with beating the market. So if we know this, well, being average is actually not that bad. If average is better than 99% of those trying to time the market, I'll take that any day. So it's ideal for passive investors. And the thing that I love about dollar cost averaging is investing can be scary. It can, we're at the end of we're 10 years into a bull market, and what we've known, for those of you that have been around during the Great Recession, it's scary. When your investments are all in the red, emotions, it's easy for to let your emotions take over. And the reason why I love dollar cost averaging is it takes the emotions out of it. And another thing that I really want to highlight is, the great retirement machine, especially here in the United States, is our 401ks. Our 401k, we're averaging in to the market, hopefully in a low-cost index fund. I'm not a financial advisor, but that's where I see the most potential, what I like the best, a broad-based index fund for my 401k. And we're averaging into that. If you have a day job, you're averaging in every 2 weeks with your paycheck, or every week with some employers. So that's the concept here. We're averaging into the market. So that's dollar cost averaging. Now, there's some that would really say, okay, there's advocates for dollar cost averaging. There's also people, professionals that say, no, you shouldn't. And coming back to what I was talking about with, well, the market actually goes up more than it goes down. So it's counterintuitive to slowly but surely buy a higher price instead of just buying on the dip. Now, the thing is no one knows when a stock is going to take a dip. I mean, you can look at historical data, charts of, okay, when has the Dow Jones or the S&P 500 historically gone down? If you look at this year alone, the S&P 500 has gone up the highest in 40, 50 years? I mean, it's incredible. Who could have planned that or saw that coming? It's incredibly difficult. And here with Ken Fisher was the CEO of the Fisher Investments, and his way of looking at it is he sees dollar cost averaging as negative, because if the market's debunking the dollar cost averaging thought here, that if the market is continually going up, you're just buying a higher price every single week. Why not have just bought it from day one? Now this comes back to what I was talking about earlier. The group of people that I'm addressing in this video are not those that have $1 million sitting in the bank. It's really those people, myself included, that are working every single day, and in some cases living paycheck to paycheck, or in other cases where you have an emergency fund, you have savings put away, but you're not sitting on a big stash of cash. Okay, that's what I'm talking about. And with Ken Fisher here, he's talking about, well, if you have a lot of money, it's actually more advantageous for you to just put it in the market all at once. And let's take a look at what he has to say about that.
Easing in is by definition a loser's game, because the more your money's going in at higher prices on average than it's going in at lower prices. Think of it another way. If you could dollar cost average over the next 30 years, you're either arguing that we're in a new paradigm where stocks don't rise over 30 years, or you're paying a higher price in if you put it all in today.
All right. So that is the assumption that I think we can all agree over time the markets will go up. There will be times when we have a correction, but over time the markets will go up. And I think that's important to understand. And I believe that. I agree with that. But it's also important to understand that not everyone has $1 million to invest today. And so if you were in that position where you are sitting on a large sum of cash, it would be, in most cases, better for you to invest the majority of it. And maybe you could do a chunk here or there, over a few quarters, every 3 months or so. But you would want to get that in sooner. And we've talked about this on this channel before. It's better to have your money, the time in the market versus timing the market is a winning strategy. Okay, but I'm not going to get into that. We could make an entire video about that. All right, the next clip here that I want to look at here is for Jack Bogle. Jack Bogle, or John Bogle, his official name, founder of Vanguard. If you watched the channel before here on YouTube, I talk a lot about Jack. I love his commentary and his advice. I see him as a teacher. A lot of the stuff that I've learned from him and reading about him and watching him. And in this clip, when Jack was being interviewed, when he was asked, okay, well, what about the concept of dollar cost averaging? His initial thought was, well, no, you want to put it in today. I mean, if you come into an inheritance of $1 million, you want to invest it today. Or maybe, in certain cases, you want to maybe invest it over a couple of quarters. But then he later goes on to say something really interesting, and then he kind of backtracks a little bit, realizing that, actually most people don't fall into a large sum of cash and are in that position. In most cases, actually, most people aren't able to do that. And so dollar cost averaging, is maybe not that unattractive. So let's sit here and see what he has to say about it.
So dollar cost averaging, absolutely yes, under those circumstances, and those circumstances are the circumstances that will apply to probably 95% of all investors.
All right. So what we're talking about here is that 95% of investors would benefit from dollar cost averaging. And now that's not, it's kind of a rough estimate that he did there on the spot there in that interview. But, saying 95%, let's take America as a subset of that, 95% of Americans would be better off if they had just dollar cost averaged into the market. And as a dividend investor, I love the concept of dollar cost averaging. For a couple of reasons. I don't over-stress about trying to time the market, missing out on dips. And quite frankly, I have a stressful job, and from time to time, I'm trying to, meet deadlines, and I really want to perform and do really well. But it's important for me to mitigate my stress, and also stress is tied to risk tolerance. And I think with dollar cost averaging, I know that 99% of people out there cannot beat the market, and it helps me sleep at night. It helps me to go to bed and understand that if the market falls, it's okay. You know what? I'm going to average in, and as we've talked about, average is not that bad. If you're looking at the average of the S&P 500 over the last 5 years, 10 years, it's been higher than the majority of actively managed funds that claim that they can beat the market. And after costs, it's not actually the case. So that's everything that I wanted to talk about on dollar cost averaging. And dollar cost averaging, we could make an entire hour, entire day-long conversation around this topic, but that's as in detailed as I wanted to go into for this video. I really try to, my audience that I'm speaking to here on YouTube is really your newer investor, your newer beginner investor looking to, grow passive income through dividend growth investing. And also for those that, are maybe more experienced and, just kind of like to see, okay, what other people are doing, what other ideas are out there, and maybe validate what they're doing and see, okay, well, hey, what is this guy saying? Is this interesting? Is this applicable to me? What do I think about it? Analyze it. And I want to be the first to say that and I've said this in other videos, there's there's not just one path to success. I'm not saying that this way is better than another in all cases. And once again, we talked about that. Every person's situation is different. For me personally, where I'm working every single day, I'm not able to invest everything that I'm going to have in my lifetime all at once. So therefore, I'm getting paid for time that I've worked until I can retire. And so that's my approach, and that's why I choose dollar cost averaging. All right, so the next thing that I want to do is I want to dive into M1 Finance here. I want to give everybody a portfolio update where I'm at. Last week was pretty brutal. Now, as a dividend growth investor, not completely avoiding the topic that people realistically did lose money if they sold. But if you're a buy and hold investor, then it's not that dramatic. I actually get excited because then I can buy these wonderful businesses at a discount. All right, over the last week, we've gotten a few dividends. We got dividends from Verizon, RTN, DRI, and AT&T. So just shy of $20 over the last week. But what I really want to focus on today is I want to look at, well, how did my portfolio perform comparative to the greater market? And if you're watching my video for the first time, or you haven't watched any other videos, I have a little bit of an unconventional approach. And if you're interested in that a little bit of a more detailed description, you can check out one of my other videos. But I have actually an unconventional approach where that I have around 100 individual holdings, stocks, and a few ETFs in this portfolio. And so if it hadn't been for M1 Finance, I would have never even dreamt of doing something like this. But because with M1 Finance, I'm able to do that, and it's fairly hassle-free. And what I want to look at here, well, how did the portfolio perform over the last week? Over the last week, we're down just shy of 2%. And you can see here the individual sectors and how they performed. Consumer staples obviously performed the best, and materials and technology performed the worst. But what I want to look at is I want to take a look at, let's go over here and let's look at the greater market, how the individual sectors did. I mean, you can see there's a lot of red in there, okay? But what I want to look at is how did my portfolio compare to, for example, a broad-based ETF fund like VTI or VTSAX over the last week. VTI was down over 3%. Okay. Now I thought that was really interesting. Well, I thought, okay, well, if I'm investing in all these companies, I'm unsure of, okay, am I going to be able to at least stay up with the greater market? What is that going to look like? And this was really interesting because once again, I've never done this in this capacity before. So this was really interesting for me to see. Now, another one, the Spider SPY that tracks the S&P 500 over the last week was down similarly just over 3%. So my portfolio beat just barely by a percentage point the Spider S&P 500. And then looking at also the Vanguard S&P 500, also very similar. Now, my portfolio is primarily filled with, your dividend aristocrats or your achievers, those companies that are a little bit more conservative, blue chip companies that have increased their dividend, 10, 25 years, even in some cases 50 years in a row. Now, the VIG tracks dividend appreciation companies that grow their dividend. That's what that fund is compiled with. And now you can see here, well, actually, okay, well, only down 2.5%. So fairly close. Mine was down 1.1, almost 2%. So it outperformed the VIG. Now, this is really interesting. This is Noble. If you're not familiar with Noble, I've done a video on ETFs in previous videos. If you're interested in that, you can go ahead and check that video out. I'll make sure I put a link in the description below. But Noble was down over the last week 2.91. Very interesting. So, and the Noble is equally weighted in the, Dividend Aristocrats, about 50 holdings in this ETF. So even Noble, 2.91% down from last week. Our portfolio here down 1.91%. And you can see here, this with M1 Finance, it factors in the earned dividends here. So $1.77, very, very minimal impact on the total return here for the week. So this was a great reassurance for me. Looking at this, well, wow, okay, I can actually get comparable results to the S&P 500 or even the broad-based Vanguard Total Market Fund in VTI and get similar results, but for free. I'm not paying any fees for the majority of these holdings. You can take a look at my pie here, and you can see the actual holdings here. I have an expense ratio of 0.01%. Okay, now the dividend yield, and I'm not going to get into this in this video, but it's only at a 2.6%. But these companies that I'm invested in, they're growing their dividend at an exponential rate. So this is what I'm focusing on. I'm not seeking a high yield today. I'm seeking companies that are growing their dividend year over year, so that down the road I can get that higher rate of return. Okay. So everybody, that's everything that I wanted to talk about in today's video. Thank you so much. I really appreciate all the support that y'all have been giving me here in the comments section. It really means a lot to me. If you like the video, don't forget to hit the subscribe button. And yeah, I'm really looking forward to your comments, your feedback, and I will catch you all in the next video. Thanks, everybody. We'll talk to you then. Bye-bye.